Let me give some context to the reason behind our interest rate decision. And it's essentially that the central bank has maintained what we call an accommodative monetary policy stance for almost 4 years. And that basically means we've kept interest rates low to help stimulate growth, particularly in the non-energy economy, and to encourage business and consumer lending. Given developments that we were monitoring for the past year or so, particularly with respect to actions by the US Federal Reserve, we and given what has the predication of the current 2014-2015 budget and what has been happening with inflation, the Monetary Policy Committee of the bank took the decision to raise the repo rate by 25 basis points. Now, essentially, what the repo rate is overnight lending to commercial banks. Because the system is typically very liquid, you find that banks don't come to the central bank for overnight lending. So the repo rate has basically evolved into what we call a signaling rate. So it signals the central bank's intentions as to how and when it would like to see changes to the general structure of interest rates. So a change in the repo rate signals a number of things. First, the fact that we've increased the rate says we would like to see generally interest rates across the board move upwards over time. Second is that we increased the repo rate by 25 basis points. So that says we would like to see rates move gradually. And the third is that that adjustment would depend on where banks are in relation to their assets and liability positions. So what you would find happening over the course of this week is commercial banks will start to look at their balance sheets and decide how they will reprice assets, how they will reprice liabilities. Simply meaning, are we going to introduce higher deposit rates? Are we going to introduce higher lending rates? And how are we going to distribute that in terms of that 25 basis points increase? So what you're going to find is a combination of interest rate changes will happen. You may find deposit rates going up, and at the same time, lending rates may also go up. I would say within the course of the coming month, you would see banks starting to make an adjustment. Some banks usually adjust faster, some take a little while, but generally you should see before the end of the month the actions of the commercial banks to this announcement. I have actually spoken to the head of the Bankers Association regarding what I would like to see in terms of interest rate adjustments. Well, I think the banks, if you look at the bank's income statement and balance sheets over the past few years, what you would notice is that while this interest rate spread, the difference between the lending and deposit rates have narrowed over time. The low interest rate environment has impacted banks' interest income position and their profitability. So you would think that banks may be a little maybe looking forward to seeing how best maybe they could raise the overall structure while maybe keeping spreads around the same level. You will have a combination of actions by banks, as I've said. It depends on their balance sheet positions. It depends on what they intend to do in terms of repricing. So that adjustment could go anywhere. Maybe fully deposit, fully loans, halfway deposits, halfway loans. That combination could really lie anywhere in the spectrum. Bear in mind, it is only a gradual adjustment that is taking place. That's the first adjustment we've made. So you may actually find that some banks may actually prefer to wait and to determine whether they would do a repricing on their balance sheets. It is a competitive marketplace, so they would have to take into account what their particular positions are with respect to their clients. But government spending always is the major driver of liquidity in the financial system. And our monetary policy stance is partly influenced by the government's current budgetary stance. Meaning, if we look at the 2014-2015 budget, we see what we call a non-energy budget deficit. simply meaning the gap between non-energy revenues and total spending amounts to about 18% of GDP, which is roughly the same level it has been for the last few years. So that by itself is not an issue, but the issue is that in the context of elevated liquidity already in the financial system, if you add the financing of that budget deficit, which is another maybe $13 billion or so, it means we would see further increases in liquidity. And that has the potential to spill over into higher inflationary pressures. So the central bank is being proactive by taking the stance basically to be ahead of the curve and prevent inflation from increasing. Right? We have another consideration in mind too, and I think that's also what I would term the primary consideration, which is the U.S. Federal Reserve has signaled that the end of its quantitative easing program may come to closure before the end of this year. Once that happens, the next step is that the US Fed will basically start to raise interest rates. The markets anticipate this should happen around the middle of next year. What that means is you're going to see higher interest rates in the United States. And our interest rates here in Trinidad and Tobago, as I've said, have been at a historical low. So we're going to be moving into unfavorable territory when we start to compare returns on TT dollar assets versus returns on US dollar assets. And we need to make sure that our deposits and investments are a lot more attractive relative to a US dollar type investment.